Hello and welcome to Options in Plain English. Today we're going to be talking about a very important topic for option traders, liquidity in options trading. Liquidity is one of those things that you can't do without. You have to have liquidity in order to get into positions and also to get out of positions. So regardless of whether you are a trader who likes to buy options, buy spreads, sell spreads, it doesn't matter. You have to have liquidity in order to trade effectively. From a financial perspective, liquidity is defined as how easily can assets be converted to cash without affecting their market price. So we can broadly define assets as being liquid or illiquid. Liquid assets can easily and without a huge loss of value convert into cash, such as stocks, bonds, options, futures, etc. Illiquid assets are those that cannot be converted easily into cash or without being subjected to a loss of value. Examples of these are real estate, fine art, equipment. When it comes to options trading, though, liquidity can be defined as how easily and without losing much value you can enter and exit options positions. So, how is liquidity measured and reflected in the options market? Well, it's reflected in the bid-ask spread, strike availability, expiration availability, open interest, volume, and also underlying volume. Bid-ask spread refers to when you buy and when you sell, the difference between the buying price and the selling price. Strike availability, how many strikes are available for that particular underlying in that same expiration. Expiration availability means how many expirations are available for that particular underlying. Do you have weekly options? Do you have quarterly options, for example? Open interest, how many contracts have been traded and how many are out there in the market. Volume, how many option contracts have been traded today. And underlying volume is how many shares have been traded in terms of the underlying. Or if we're referring to futures contracts, for example, how many future contracts. And it depends on what type of underlying you have. Now, we're going to look at an example so that you can see what we look for and what we are expecting to see when we talk about liquid underlyings versus illiquid underlyings and liquid options versus illiquid options with a real example. Here we have the options trading page for IWM, which is the ETF for the Russell 2000. It's currently trading at $124.37, and these are IWM's options. The first measure of liquidity that we're going to take a look at is the most important one, and one that I would say is critical for us as option traders. It is the bid-ask spread. The bid-ask spread is the difference between the price that we can sell an option at and the price that we can buy an option at. So in a very real way, it is the cost that we would have to have if we want to buy an option and then right away turn around and sell it. Just because of doing this, we were going to have a loss, and that loss is measured by the bid-ask spread. As you can see here, for example, we have the May expiration open and we have the June expiration open, and we see all the different expirations, and here we have the at the monies for calls and puts, and we can see that we can buy, for example, the $124.50 strike price. We can buy that one for $4.38, the call, and we can sell it for $4.34. And the put, we can buy it for $4.48 and we can sell it for $4.45. So the bid-ask spread in this case is 3 cents here and 4 cents here. Now, how would we know if a certain bid-ask spread is okay for us to trade? Well, there's many there's many ways people or traders have looked at this, but the one that we like to take a look at, and the one that we use to determine whether an option is liquid, is the a comparison of the bid-ask spread when compared to the price of the option. So for example, in this case, 434, 438, the difference is 4 cents. That's the bid-ask spread. 4 cents, what percentage does it represent of the whole option price? So in this case, 4 cents out of 434, we'd be talking about around 1%. Remember, you don't have to be exact by calculating this. I'm just doing it quickly in my head. So it's about 1%. So what we like to see in terms of bid-ask spreads is that we have a bid-ask spread of less than 5%, and that's what we like. But if we have a play that we desperately want to get into, we could relax those requirements and maybe push the limit up to 10%. But under no circumstances would we go higher than 10%. So we like to have less than 5% in bid-ask spread, ideally closer to like 2%, 1%, like this. And under no circumstances, again, would we go above 10%. Another thing that we can notice here is that the liquidity is, for the most part, and this is a pattern that you're going to see all over the place for every option and for every underlying, is that the liquidity is going to be concentrated around the at-the-monies and in the front months, so in the front expirations. So when you take a look at the bid-ask spread, it's important that you take a look, yes, at the front expirations, and at you take a look at the at-the-monies and very slightly out of the money. But you should also make sure that the liquidity is constant, or even though it's not going to be the same, that at least it maintains a certain basic level of liquidity all across the different expirations and along the different strikes. So all the different strikes. In general, what we know already is that out of the money options are more liquid than in the money options for calls and for puts. So as you can see here, for example, well, actually, in the case of, for example, here, the 122 call is in the money, and you can see that it already went to 6 cents, which is not that bad because it's out of an option price of $5.84, $6. So it's still about 1%, which makes it still liquid. So to summarize it, bid-ask spread, the most important measure. This is going to be a drag in our results, in our returns. So over the long term, when we start trading, buying and selling options and spreads and everything, you're going to notice that this is going to be something that you're going to have to take out of your returns. So it's important for you to try to minimize the impact related to bid-ask spread. Another reason why this is so critical is because right now, for example, we have a calm market. The market is nothing really big is happening right now, so we have very stable and orderly markets. In this situation, yes, you have very liquid markets all over the place. However, when things start getting volatile, one of the things that start happening when the market starts getting volatile is that the bid-ask spreads start to get wider and wider. So the market starts to widen, and what happens is something where you thought you had good but not excellent liquidity suddenly starts becoming a very illiquid market. Whereas positions that you have in underlyings where you have excellent liquidity, those are going to be good liquidity when things start getting volatile. So meaning you can still get out, you can still adjust, you can still roll to different expirations. So it's important for you to make sure that when you trade, that you select the underlyings that have options with a good bid-ask spread, which is the most important measure of liquidity. Now moving on, the second one is strike availability. So what you want to see when you start analyzing and seeing whether you should trade an underlying or an underlying's options is you want to make sure that you have enough strike prices and that they are spaced out, not very with not a lot of space between the different strikes, so that you have the flexibility to, for example, if you start and you decide to sell, for example, the 125 call, and then you want to adjust that and you want to, for example, move to the 126 call, then that strike is available. There are situations where some underlyings don't have this many strikes, and here I'm only showing 10, but there's plenty more. You can see how they're spaced every 50 cents. This is because this is about to expire. This one has 11 days to go, but this underlying is in this respect very liquid, because in the front expiration, one of the front expirations, the first monthly one, you have 50 cents between every strike price. And in the one with 46 days to go, you have $1, which is still very liquid. When you start getting into illiquid underlyings, what you're going to see is you're going to start seeing $2.5 difference between strike prices here, or even $5 or even 10. So if that's the case, then you don't have as much flexibility to adjust and roll the position that you have as you would like. The third measure is expiration availability. So you want to make sure that you have many expirations available to you, because once you start, once you initiate a position and and you have something on, you want to make sure that you have the flexibility to, for example, roll to the next week. So usually what happens is you have several types of expirations. So you have the monthly ones, and then you have some that are called quarterly, and then you have some that are called weekly. The weekly ones are only in something like the next month and a half. And the monthly ones, you have usually the next month, the one after that, and then based on a certain cycle, and which cycle they have, roughly every 3 months or so. And then you have the ones in January, which are called leaps. So what you want to do is, and this is just a quick look, you want to make sure that you have enough expirations available to you. Basically, make sure that you have weeklies and monthlies, and not very many underlyings have quarterly, but most of the liquid ones will have weekly. So as you can see here, you have this week and then the one after, and then there's a monthly one, so there is no weekly here, but you have the one after and the one after and the one after and the one after. So you have a good granularity here, so that you can go and select, for example, 32 days to go, or 25 days to go, or 18 days to go. If you didn't have the weeklies, then you would have the 11 days, and then the 46 days, and then the 74 days. Not a lot of choices. Having choices is always important for us as option traders. Now we're going to move on to the next measure, which is open interest. Open interest represents the number of contracts that are out there for that particular option contract. So we're talking about the strike price and the expiration in particular. So for example, for the 124 call, you would have this many options, or that many option contracts as open interest. And for the 124 put, you would have this. And then for the 124 in a different expiration put, you would have this and this. So for every combination, you have a certain measure of liquidity called open interest. Why do we have open interest? Well, when you trade stocks, what you have is a certain number of shares outstanding. So the shares that are in the market are called the float, and those shares are the ones that are changing hands. When we talk about options, it's a little bit different. When you want to buy an option, as long as you find the seller and then you agree to create to do the transaction, then you're going to create an option contract because it's a derivative contract. It's based on the value or the price of the underlying asset, but in reality, you create as many as you need. So if I need to create 30,000 contracts and I find a seller who sells me those 30,000 contracts, then I have 30,000 contracts, and that would be the open interest. If I need 100,000, then 100,000. So you can create as many as you need as long as there is the interest, which is why it's called open interest. Now, it's important to notice here that depending on the type of transaction, the open interest changes, and sometimes it'll add to this number, sometimes it'll subtract from this number, and sometimes a transaction will not modify the number of contracts that are here represented in the open interest. So, for example, if I have if I already bought an option, let's say I have the 125 call for June, and I decide to sell it, then I initiate a transaction called the sell to close. And after this transaction goes through, then if the other party was issuing a buy to open, for example, then my sell to close and their buy to open doesn't actually modify the open interest, because that contract is still alive and it just changed hands. But for example, if I initiated a sell to close and the other party had a buy to close as well, so both of them were closing, then that contract disappears and we no longer have it, and it's reflected in the open interest. Now, this number is not instantaneously reflected here. I think it's once, I believe it is once a day. So by tomorrow, you will have the new open interest number. So what you want is you want to see the interest in this particular contract or in these particular contracts existing and a healthy number, because that's going to represent the potential number of buyers and sellers when you want to get out or adjust or roll your position. So what you want to do is you want to see an open interest greater than 1,000 contracts per strike. Now you have to be flexible here, and remember, these are not critical. The only one that's critical is bid ask. These are not critical, but those are some numbers that you'd like to see. So for example, here, if you take a look at the open interest, you would see that you have a healthy number of contracts here being traded. So if you decide to buy one of these or sell one of these, you know that there's going to be traders here who are going to provide you with the liquidity for you to get out eventually when you need to. Same with puts. So if you take a look here, we have 5,000 here, 3,000, 12,000. So it's a very liquid. So far, this underlying is very, very liquid. We'd like to see at least 1,000 contracts per strike, and we are seeing that. The next measure is volume. So those are the number of contracts that were that change hands, or the number of transactions for those contracts that are happening during the day. This number is instantaneous, unlike the open interest. So this one you can see in real time, and volume, although it's a good number to actually look at and to analyze, is not one of the ones that I would call critical. And what we'd like to see here is just around 1,000 contracts per underlying. So altogether, for all the different contracts, we'd like to see around 1,000 contracts, because that means that today the options for that underlying are being traded a lot, meaning that there's healthy interest and that potentially if you are in a position, you're going to be able to get out. Finally, the one that is the least important one is underlying volume. So if you look at the volume for the stock, in this case for this ETF, then you're going to see a certain number, and that number, even though it's not very important because it's not directly related to options, still when you have positions, you have the choice to maybe hedge certain positions with underlying. So for that, you would need a good healthy liquidity on the underlying, not only at the option level, but also at the underlying level. So for example, here you would take a look at IWM. We have almost 14 million shares already traded, and it's about noon, so just going to be many more. What we would like to see here is a volume of something higher than 5 million shares, so that we can, if we need to, we can hedge and we can complement our options with also the underlying itself. So in summary here, if we look at IWM, we've seen that the bid-ask spread is around 4 cents. The strike availability, there's a lot of strikes available. Expiration availability, there is many expirations available. Open interest is very healthy, as well as volume. And the underlying volume is also very good as well. So we could say that this underlying and its options are liquid. And that means that depending on what position we want to put on, we are given here the green light to go ahead and start a position there, knowing that there is a very, very high probability that we're going to get out, and we're not going to be paying that much in difference between bid and ask. So we're not going to have this drag in our returns over a long period and over a high number of trades. This is why the underlying being liquid is so important. Oh, and another thing I'd like to mention is that a certain underlying can be liquid at a certain point in time and then change its that characteristic later on. So for example, if there is an underlying that the market is really interested in where there's a lot of trades going into that underlying, and then all of a sudden the market loses interest and liquidity starts drying out, then what's going to happen is that underlying is going to go from liquid to illiquid. And when it's liquid, we are okay putting on trades, but when it's illiquid, then it's going to cost us a lot. Now, it doesn't mean that we're not going to make money. We could, but we're paying a lot for it. The cost of doing business is very high. So that's why we like to have, and one of the things is that's non-negotiable when we initiate trades is we only put on trades on liquid underlyings. Now, if we put it on when it's liquid and then it becomes illiquid, well, we got trapped. There's nothing we can do. But knowingly, we should not enter into a position knowing that it's illiquid, because that's going to cost us a lot, and we're going to be really trapped later on. Where we have the worst position to be in is when we have a position and we can't get out. So in summary, IWM is a liquid underlying, and if you have a strategy that you'd like to put on, then you're more than okay to put it on, and you're going to be making money or losing money depending on how the strategy moved, but not because of illiquidity. Now let's take a look at a different example. In this case, we're going to be taking a look at WWE, which is the World Wrestling Entertainment, very well-known company. And this is a good opportunity to make sure you understand that the fact that a company is well-known doesn't mean that either the underlying is liquid or that its options are liquid. So just because you know the company doesn't mean that that it has liquidity at the underlying level or even at the options level. So in this case, we're going to perform a similar analysis that we did with IWM. We're going to take a look at the bid-ask spread. So to begin with, right away, we have the May and the June, 11 and 46 days to go. The at the money, which are the most liquid options. And you can see that the bid-ask spread for calls, for example, is 25 cents, so 150, 175, 25 cents out of a price of 150. So 25 cents out of 150, we are talking about, I don't know, 15% or so. And here we have 50 and 65, so 15 cents out of just about 60 cents. So we are talking about 20% or 25% bid-ask spread. So 25% bid-ask spread, just around 15% or so bid-ask spread. I can tell you that this bid-ask spread is too high. So we'd be paying 25 cents in difference to potentially trade something that's worth 150 or 160. So another thing, something I didn't mention before, usually because we have a price to sell and a price to buy, a bid and an ask. When traders refer to a certain price, usually what they mean, and if you need to use a single price for that option, usually what you would do is you would get the mid price, so the price that's in between the bid and the ask. So for example here, the mid price would be something like 57 cents, and here the mid price would be something like 162. Okay, so as you can see, the bid-ask spread is too wide here, and these are the good ones. Okay, so these are the at the money that have very little time to go. So this should be the most liquid options. So you can imagine the rest of the options chain is going to be more illiquid. Okay. So we'd like to see less than 5% and the maximum number of 10%. So here it doesn't pass the test. Strike availability. Take a look. The WWE is trading at $44. Okay, so the strike prices that we have are 40, 45, 50. So there's $5 in between every strike price. So there's not a lot of granularity. So if we wanted to trade, for example, the 48 strike, there is no 48 strike, not even in the front expiration. So let alone if we start looking at the 46 days to go or anything that's later, any later expiration. So definitely there are not a lot of strikes available for us to trade. So strike availability would not be enough for us to trade. So it doesn't pass the strike availability test or liquidity test. Number 3, let's take a look at expirations. Well, there are no weekly expirations. There are no quarterly expirations. We can trade the 11s, the 46 days to go, the 74s, the 165s, the 256, and then the 627. So what if we wanted to buy a 3-week option? Well, it doesn't exist. What if I initiate a position and then I want to roll out in time and I want to go from 11 days, I want to go to 30 days? Well, it doesn't exist. So there's not liquidity in the expirations department. So of course, I would say that it doesn't have enough liquidity when it comes to expirations. Open interest. Yes, the front expiration has, especially at the money, has some open interest, but it dries out quickly after that. So for example, here the in the money calls, for example, the 25 call has only one contract open there. So if you wanna sell 10 contracts, then you can see that there's not a lot of traders that are already in there. So they're going to give you whatever price they want, and you're not going to get very good liquidity if you want to initiate or get out of a certain position there. So the open interest, you can see there is some open interest, especially in the front expiration, but it's not nearly enough for us to consider this a liquid underlying when it comes to open interest. Take a look at puts, for example, here with 46 days to expiration. Not a single strike has over 1,000 contracts. So what if you want to trade 100 contracts, which is not a lot considering that they cost 190 to 210, so it's about $2. So $2 is $200 per contract because it's 100 shares. So $200. So if you want 100 contracts, that's $20,000, which is not very much. So of course you wouldn't have the liquidity here to the strike price here, the 40 put for June. Yeah, you're gonna get filled, but what price are you gonna get? I mean, you are going to be the one moving the market, and that's something that you don't want. Remember, liquidity is the ability to turn something into cash without losing too much value, without you being the one who moves the market. If you want to trade 50 shares here, 50 options here, for example, for the $35 call in June, then there's only 5 contracts. If you want to put on 50 contracts, you're going to be the one initiating the market. You're going to be the one moving the market. You're going to get very bad prices and very bad fills. So the open interest, although there is some open interest, it's not enough to be considered liquid. Okay, remember, we want 1,000 contracts, but over many strikes, not only at the money. Volume, you can see the volume here is pretty lousy, I would say. It's only 28 contracts traded today, 5 and 4 here, and 13 and 30. So not a lot of volume. Again, if you want to trade 100 contracts, you're going to be the one who's going to be moving the market here, and you definitely don't want that. And finally, so we want 1,000 contracts per underlying. We don't have them. And finally, underlying volume. Let's take a look at WWE. We have a volume of 168K, so 168,000 shares. So definitely less than the underlying volume that we want of at least 5 million shares. And you can see reflected here in the bid and ask for the actual shares. You can see that it's 8 cents. Usually this one is very tight, so 1 cent or 2 cents. This one's 8 cents in the actual underlying. So you can imagine that the options are not liquid at all. So if you have a strategy and you think that you can make money with WWE, whether you wanna, whatever it is you want to do, you want to sell a credit spread, you wanna buy a debit spread, whatever it is, buy a call, buy a put, sell a call, sell a put, it doesn't matter. If you think that you can make money, well, you're gonna have to pay a hefty price just to get in and get out. So your returns are gonna have to come the price of admission, so to speak, is going to have to come out of your returns. So your returns are going to be negatively affected by the lack of liquidity. Again, just to summarize this, liquidity is king. Some traders like to trade tech companies or discretionary companies or staple companies or only ETFs or only future contracts or options on futures or index options because they are settled to cash. Whatever it is, I'm okay with all of that. You can trade whatever you want. But the one thing that's non-negotiable, the one thing that you always have to have is liquidity. There is no excuse for you to start putting on trades on illiquid underlying because it's going to hurt you in the end. And I've gone through it. I've seen traders go through it, and it's a very bad situation to be in. So if what you have at the end of the day is a list of underlyings that are liquid right now, and that list is only made up of, I don't know, 70 underlyings or 100 underlyings, whatever it is, and those are the ones that are liquid. Okay, so those are the ones that you can trade. Don't go into illiquid underlyings. That is the number one reason why traders lose money. So the whole reason for me to make this lesson in this video is for you to understand and to hammer into your brain that you need to trade only liquid underlyings, only liquid options, because then your strategy can be the one that makes or loses money, and not the mechanics of going into the market or coming out of the market, like they would be if the market is not liquid. And then you're going to have to you're going to have to absorb those costs into your returns, and then it's going to be much harder for you to make money. So again, do not trade illiquid options. Do not trade options on illiquid underlyings. Stick to liquid and try to be creative. If you want to trade the oil market and you want to go into some obscure oil producer, and you go there and it's not liquid, okay, but you think that the market is going to be affected in a certain way, so okay, so go to the majors, or go to an ETF, go to Exxon, or go to ConocoPhillips, or go to Chevron, or go to the energy ETF XLE. It doesn't matter what you do, just stick to liquid underlyings. Very important. In this case, if we take a look at WWE, you might like the product, I do, but for us to trade, it's definitely illiquid, and I would not put on a position here. The most I could do is, okay, so if I want to, okay, I could buy the underlying, I could buy the stock, but I'm not going to dabble in options at all, because illiquidity is a killer. And that's the main purpose of this lesson. And I hope that this was made clear, and I hope that this was useful for you, and I hope that it helps you in your trading, and that it helps you stick to liquid underlyings, put on the strategies that are going to make you money today and over the long run. Thank you very much for your attention. Goodbye.